Hello, Maverick traders. Welcome out to your trading room as we prepared for the week ahead. It's going to be February 19th through 23rd upcoming. We just passed the February monthly options expiration cycle. Now, we always go through the broad markets. We talk about sectors. We talk about where rotations are happening, any major news, anything like that. And then, of course, we always highlight some specific trade setups. Usually utilizing options to do so, but you could trade stock as well.
Disclaimer. This video was created for professional stock and option traders. Maverick Trading is a proprietary trading firm that employs professional traders around the world. Our traders trade firm capital and keep 70 to 80% of profits they generate. All trades and analysis in this video are for professional traders only. If you are interested in becoming a professional trader for Maverick, click the apply button in the video description. Let's get ready for the week.
So as we take a look at this week, it's kind of interesting how it shook out. Broader markets initially pulled back and then started to recover, and it finished as essentially a sideways week for the broad indexes. But CPI was what really derailed the markets temporarily. When we saw that big drop, it happened on Tuesday. It happened following the CPI data, and that came in much higher than markets wanted, much higher than the Fed wanted. And so let's zoom into that. It came in at 3.1 versus 2.9 expected. Now remember, the Fed's mandate is to keep this inflation, what they call price stability, and their goal is 2% inflation rate. So at 3.1, that's clearly too high, and this is what they screwed up previously. So it was the major focus. There were a few other items. Retail sales disappointed. Empire Manufacturing beat expectations. And then PPI also came in hotter than expected, quite a bit hotter, 0.5 versus the 0.1 on the core number, 0.3 versus 0.1. That's the producer price index. But again, inflation is just a little too high, a little too hot. The idea that the Fed's going to come in slashing interest rates is now being taken back. There's no question about that. So as we look at the markets, the performance this week, again, was an initial drop on Tuesday with the CPI and then a bounce back the rest of the week. We finished essentially flat and unchanged in the Dow and the S&P. NASDAQ lagged down 1.5. Russell 2000 up 1, so there was a broadening out of the rally. It was the reverse of what we had been seeing lead the rally, where large cap tech led on the way up. They certainly lagged this week, and the rally broadened out. All of the underperforming sectors had their best week in some time. It was kind of interesting, that change that took place. Oil, gold, slightly higher, and oil's been on a bit of a run back to the upside. But as we take a look at the markets, even with large cap tech struggling, we are at right up against that short-term resistance, but still essentially at new highs and new all-time highs. The market tried to break, and we rallied it right back up. So where do you go from here? We're probably marking time. Remember, consolidation patterns after big runs higher are bullish. They speak to the strength, that underlying buy the dip mentality, the fact that they can't even push the market below this 20-period moving average. It's just a strong market environment. Now, the NASDAQ, essentially the same thing, kind of an ugly day on Friday, but we're still in this high basing triangular type of pattern. And so until we really see a breakdown, you can't guess that it's going to happen. If you tried to just predict it magically, well, you'd have gotten bearish at all sorts of intervals, which were just buying opportunities. So I think I'm not seeing anything that's catastrophic here and capitulatory, kind of an exhaustion high, anything like that. I think we're still just kind of consolidating after a run. I'd anticipate still another push to the upside is where I would be leaning. Now, as we look at this rally, there's a lot more green on here than red, but the individual companies that are red, Google, Amazon, Apple, Microsoft, these are such big components. that if you subtract those five names, which you can't do, but if you subtract those five, the S&P and the Nasdaq and the Dow, they were all nicely higher on the week. So we had a sideways week because for the first time in a while, the large cap tech names were lagging. But this is even more reason to kind of say, well, if these other sectors, that means there's a lot more stocks to choose from if the rally can continue in this manner. It would mean that maybe the index doesn't go up that much if these large cap tech continue to struggle, but it would mean that a lot of other stocks are now rallying. And we've seen improvement in the quantity of stocks above their 50 period moving average and so forth. So the breadth, the amount of stocks going higher, actually improved this week, believe it or not. Like we said, the Russell 2000, which makes up a big long list of stocks, was actually up almost 1.5% on the week. Now, we think we're in this blow off top phase. I've been saying this for the past few weeks that I've been doing the trading room. It's what I'm anticipating. And look, it's been helpful because we've stayed bullish and the market continues to chug its way higher. So the blow off top will be a big screaming rally, a big vertical spike, a big candlestick when the news and everything seems super mega bullish, and it'll be a good time to reverse and kind of say, okay, things have gotten ahead of themselves. But I haven't seen that really in dramatic fashion yet. Technicals are going to take center stage because we've got a holiday shortened week coming up. Markets are closed on Monday for President's Day. So there will be no stock and option trading, etc. But while we don't have a lot of economics, there's still some earnings to pay attention to, and specifically in the retail space. Retailers always seem to report at the end of the earnings season. That's traditional, that's normal. Home Depot, Palo Alto, Walmart, two of those are big retailers, right? Rio and Nvidia, Bookings, EOG Resources, Intuit, Mercado Libre, and then finishing off with Berkshire Hathaway. Now, Berkshire's meeting is actually, and release is actually on Saturday, not on Friday, but that comes out this next weekend. So retailers are now going to report. There's quite a few companies still to report. I don't think it's going to be major market moving, but it can be individual stock moving, no doubt. So as we look at the economics, I mean, there's not much here. US dollar that's impactful, not until Thursday, and you've got some PMI data, which typically is not a major market mover either. So I would say there's not a whole lot there. We've got FOMC meeting minutes. If I were going to highlight the one thing to pay attention to, it would be right there, just because the meeting minutes give you a little more sense of what the Fed's discussions were, how close they might be. We can extrapolate some of their commentary as to, are they really even considering interest rate cuts in the foreseeable future? Certainly it seems that March is already off the table. Markets were expecting that, and here at Maverick we certainly were not. So I think you're still going to get commentary that's a little bit more hawkish, a little bit less inclined to cut rates quickly and in dramatic fashion. So, steady as she goes. I think Friday wasn't the best trading session, of course, but still the overall trend is marching higher, and consolidations after the type of runs we've been on is nothing but really pretty bullish still. So as we look at sectors, you're going to see a little bit of a broadening out. So performance wise, look at how energy and materials and utilities, those were three of the top performers. Now, granted, we had these three sectors as +3 outlooks. These were our three +3s, and they were also very strong at up 1%. But here we had a very bearish sector, and these were, zeros to -1 type of sectors. The underperformers and the outperformers both did pretty darn good. The only sector that really struggled was tech, and even within technology, it wasn't really tech. Again, it's that small but huge corporation list, right? Whether you want to call them the Magnificent Seven or whatever your acronym is for them, it's Apple, it's Google, it's Amazon. Those were the only companies that really struggled, it seemed. Everything else was pretty healthy this week. So all in all, pretty good price action across the board. Now let's look at some sectors here. Utilities, a little bit of a bounce back, but that's not much. I would still grade it certainly in a downtrend, below downtrend lines and such, downward sloping moving averages. Utilities still look like the worst sector out there. Communication services, we're consolidating up here near the highs. Usually you'll leave in the way that you came. Still looks pretty healthy and bullish there in communication services. +2 rating remains unchanged. Real estate, little bit of improvement in real estate. We took that up just a notch, but having said that, still bearish. If you were going to say what are the two sectors that are still trending lower and still below their 50-period moving average, there's only two. It's real estate and utilities. So those are two that are still in the bearish side. Healthcare, we've maintained a +3. That sector traded very well this week. Looking at the chart, I mean, obviously lower left to upper right. We just made new highs this week. Everything looks pretty solid there. Let's jump over to industrials. Same thing. It broke out weeks ago. It continues to push higher this week. Great price action. Remains very bullish overall. Financials, same idea. It had consolidated for a couple of weeks, has broken out to the upside. We've got that at a +3 as well. Next, we look at consumer. Now, consumer has started to emerge here in the short term, but still below the highs from last fall. So you're in a consolidating pattern. You very well can move up and out from here. It's more bullish than bearish, but we still have that more at a +1. It's not as healthy, as strong. It doesn't exhibit the same relative strength that a lot of other sectors have had. Technology took a little step back, but if you look within, again, it's that small handful of stocks is really what hammered it. I think within technology, you could take it down one more notch. If you wanted to go to a +1, I could understand that. We still have the upward slope. We still are above the 50-period moving average. We did just barely close below the 20. So, if you wanted to call that, it's kind of +1.5, +2-ish is how I see it. Materials was a changer, right? It went from downward trend and has broken higher. Now the question is, you've got a mixed picture. You've got the 20 below the 50, but they're trying to slope upward. It's sort of like consumer in that it's trying to do some good things, but it certainly has not been a runaway bull market. You have this resistance up here along the top. We'll call it 86, and change. We gave it a +1, certainly more bullish and acting better in the short term, but I wouldn't jump on that as though it's ready to take off. It's still a question mark. Energy, similarly, it's just stuck in this range, and so within energy, I'm going to keep that more at a 0 rating. Now, I get that it broke higher on Thursday, it consolidated on Friday, it may be on the cusp of really pushing higher, but we're not really in a strong upward trend or anything like that yet. So we're still below those prior highs. It's still got some work ahead of it. Here's how we graded them out. Financials, healthcare, and industrial certainly look the best. If you wanted to take technology down a further notch, I could understand that. If you wanted to be more optimistic on some of the +1s, I could understand that as well. Utilities and real estate are clearly the two bearish sectors. They're the only ones, again, below those 50-period moving averages. So you've got a smaller group of sectors trending poorly. You've got a much bigger group trending quite well. Now, possible trades here. First possible trade, I'm going to highlight utilities. Still bearish, certainly the sector. You look at something like Southern Company, and we just broke to new lows. We see this. If you need to add a bearish candidate, this could be an interesting trade. The March 8th, buy the 67 put, sell the 65 put. It'll cost you about 65 cents, might be a little more than that, 70 cents, something like that. Max risk 65, max reward $1.35, about a 2-to-1 reward to risk ratio there. And max gain is if it's below 65 in about 3 weeks. As we look at this chart, you can see again that push to new lows, and that's key in that we've got downward sloping moving averages, we've got lower highs, lower lows. This sector continues to underperform. There's just a lot of supply, and a lot of times that can intensify further. So it would be just simple trading the trend, trading the current momentum. If you were looking to add a bull, Wells Fargo has not received high marks for business, for the way it's treated customers, for all these sorts of things for some time. But lo and behold, Wells Fargo just went through an ascending triangle and has just broken out on volume. So it doesn't have to go higher, but generally speaking, when that type of breakout occurs, you get further and further building. So again, March 8th, about 3 weeks out, buy the 51, sell the 54, pay about $1.30. Max reward, whoops, I've got a typo there, would be $1.70. So I'll correct that. $1.30 risk, $1.70 type of reward, and max gain as long as it's at 54 or higher. So risk to reward wise, decent. Probability of success seems reasonable as well. Wells Fargo, bullish breakout. And then last is technology. Now, I could understand someone being worried about technology, the sector, but most of technology is not trading along with Apple, Amazon, Google. So I was looking at tech and some of these other kind of high flyer-ish type of names, the snowflakes, the Datadogs. There's a lot of companies within tech and a lot of different industries. This one is in the software space, but you can see the high basing pattern after a big ramp higher. Here's the breakout. When you consolidate up near those highs, that is a healthy sign and likely more to come. March 1st, this is only a 2-week trade. Buy the 230, 250, sell the 240 calls. You're paying about $3 for that. It's a $7.50 wide spread. So that would leave you $4.50 of potential reward. So about 1.5 to 1 reward versus risk. And the risk graph on this is bull call spread, like such. You'd have your break even in here. You'd have your profit and loss numbers. And max gain up there is if it can get to 240 per share or higher. Max losses if it's at 230, 250 or lower. And your reward of $450 of potential reward, we can put that over here, versus $300 of max risk. So that's the structure, that's the idea there. If we look at Snowflake, again, just nice little high basing pattern after a nice run higher. These usually revert to the upside. And notice that if you subtract that Apple, Google, Amazon type of names, there's a lot of tech that's still trading quite well. We're likely trading in that blow off top phase. When that happens, I personally would be very cautious and be a little bit more careful with the markets in terms of my aggressiveness and whatnot on the discretionary side. Otherwise, you're just kind of trading your plan and sticking with the plan if it's a non-discretionary type of strategy. Remember that we've got President's Day on Monday, so markets are closed. Then back at it with market roundups and updates throughout the week, and then we'll conclude with this type of trading room again next weekend. So hope you enjoyed it. Have a great long weekend, everyone. We will be back next week, and we'll see you then.